This meeting is being recorded.
We will be starting very soon. Just waiting for a couple of others to join us. Okay. Maybe in 1 minute time, we should start.
Okay. Is it compulsory you join it?
Okay, I think it's 5 past the time, so we should start. Others will join us. Good evening, everyone, and thank you for joining this task session. I believe you can all see my screen. Hello, can you hear me?
Yes.
We can hear you well, and we can see the screen.
Okay, so I will advise that we pay attention to the screen because I'll be showing a lot of examples of some of my clients, what they are doing to optimize their personal taxes and corporate taxes. So there will be a lot of numbers that will be displayed on the screen. So please pay attention to the screen. So during the course of the session, we'll be looking at the 2021 income tax rates for personal and incorporated business, then just a glimpse of how the CRA calculates our refund or balance owing, what is driving that. Then we'll be looking at the traditional ways people use to reduce their taxable income. Also the modern ways, what people are using now, especially the wealthy people, what they are using to reduce their taxes. Then a little about us accurate consults. Then the question and answer period. Now, this is the tax rate for 2021. To the left of my screen, I got some caption from CRA website. This is for the federal. Excuse me. I lost my pointer. So this side of the presentation of this slide speaks to the federal rates. So for someone that earns taxable income is below $49,020, the federal tax rate is 15%. So this is how it works. So we have federal rates, we also have provincial rates. So what we have here on this side is the federal rates. And I just pick for some provinces, Ontario, Alberta, and Manitoba. I know that a majority of us, we fall within this province. That's why I took a snapshot of these 3 provinces. Then moving to the right side of the page. So you notice that on the average, for someone that earns the taxable income is around $49,020 in Ontario, federal taxes plus the provincial taxes around 20%, while in Alberta is 25%, while in Manitoba is around 26%. So if your taxable income is this amount, this is the tax rate you pay effectively. It will be around this rate. But for people that earn within this range, between 49K and 98K, your taxable income is within this range. You'll notice that in Ontario, $1 out of $4 is paid back to the government. So you pay 25% of your taxable income as combination of the federal and the provincial tax. In Alberta, it's close to 30%. In Manitoba, it's close to 30%.
Hello. Kini session ṣẹyẹ ni.
Okay. I think I need to mute every other one. So on the average, you see that we are paying a lot back to the government, either the federal or the provincial government, from our personal income taxes. And if you look at the business, if you have an incorporated business in Ontario, the federal tax rate is 9%. And there's what we call the lower band and the higher band for incorporated business. Because government wants to encourage small business to operate within Canada, we have what they call the small business deduction, which is around 500K. So if the income you make from active transactions, from your active business activities is less than 500K as an incorporated business, then you enjoy the small business deduction, lower rate of 3.2% in Ontario, while the higher band is 11.5%. So what this means is that if your income is less than 500K, this is what you pay effectively in Ontario on your incorporated business net profits. You'll be paying 3.2% on your net profits, plus the federal rate, which is 9%. So effectively in Ontario, for small businesses, you're paying around 12.2%. While in Alberta, federal is 9%, the lower rate is 2%, which is 11%. While in Manitoba, interestingly, is you pay 0% if your taxable income for the business is less than 500K. So you only pay 9% in Manitoba, which is the federal rate. You don't pay any provincial rate on your incorporated business. Please, I need to mute. I need to mute every other person. Wow, how do I do that? Mute or okay. I think that's it. Can you all hear me now? Hello?
Yes, we can.
Yes, we can.
So from this slide, what we can see is that it's good to have a business, because if you operate your business as a sole proprietor, the net profit of the business will be added to your salaried income. So you'll be paying a higher income tax rate if you operate as a sole proprietor. That's why it's advisable, if you have a small business, you should incorporate it. Although sole proprietor also has its own advantage, we'll consider that during the course of this session.
Please, can you take that again?
So if you have a side business, a side gig, if it's possible, and the income you are making from that side gig, the net profit is positive, it's recommended to have that business incorporated. Because what we do is that from your sole proprietor income, the way the tax structure is designed is that the net profit from the sole proprietor is added to your salaried income, your personal income. And that is how we derive the taxable income on your personal income taxes. I believe that is clear.
Yes, it is.
So the message is, if you have a business and you are making a lot of money from that business, it's better to incorporate that business so that you can reduce the taxable income you'll be paying effectively to the government. But if the business is the profitability is low, you can operate the business as a sole proprietorship.
What range is low? What range do you think is low?
Yeah, if you are still doing within the net profit is between 5 to 10%, $10,000, that is still low. But effectively, which we're going to look at during the course of this presentation, if you're in Canada, it's good to have both sole proprietor and incorporated business, because both of them has their different benefits in terms of tax purposes. We're going to consider, there's a slide that tries to explain that. Then this slide talks about how to assess your tax slip on CRA. So during the course of the pandemic, we realized that from experience, some of our clients, some fraudsters got benefits on their profile, on their social insurance number. And they said they're not aware of who got this SEB or this benefit from the government. And the expectation is that government expects you to pay taxes on those government benefits. Now, what we recommend is that before you start your taxes, go to CRA website to see all your tax slips. At the minimum, that's what CRA is referencing. They are referencing what they have on their website. So what happens is that towards the end of, between now and the end of February, employers will send your tax slip to CRA. CRA will upload those tax slips on their website. Now, what CRA does is that when you submit your file your tax return, they check what you have submitted against what has been submitted against your profile. So we always recommend that before you complete your tax filing for a year, go to CRA website to see what has been logged against your SIN. So to the minimum, that's what CRA want to see. They want to see that all this income, all these benefits have been captured against in your tax filing at the minimum. Then there's some information that CRA will not have, maybe some other side gigs, and they expect you to report such income. So these have to access this on CRA website. When you log in on the website, you go to the related service section on the website. It's towards the far right, the middle of the far right. You click on your tax information. When you click on tax information, what you will see is you take to another page, the tax year. You see, select a drop down to see all the tax slips. Then you click on next. So when you click on X, you will see all the tax slips that has been logged, that's been submitted to CRA by employers, financial institutions. Then you click on them. Like this is a T4. You click on this and it will open. So you see what has been reported against your profile. It's just for completeness sake. We recommend that taxpayers check their CRA profile to ensure that all what has been logged against them has been captured in the tax filing. And also, if there's any fraud on your SIN, at least at that point, you pick it up, then you can engage CRA that I did not apply for this tax benefits, so I should not be charged tax on it. Then this slide explain on how tax refund or owing is being calculated. So from your salary income, if you have a business income, other income, then total income. From your total income, we have deductions like RSP and the likes, which we're going to talk about, your deductions to reduce your total income. We arrive at the net income. From net income, we have other deductions. Then we arrive at the taxable income. Now, the goal is to reduce this taxable income amount. That is the goal of the tax tools and the various tax credits. The goal is to reduce your taxable income because this is what is being used to derive your balance owing or tax refund.
So that's the only thing, no?
Yeah.
And this one.
So from
Hello, Shay.
yeah,
Please, I have a question.
okay.
I see on this slide there is salary income plus business through self-employment income plus other income. What's the difference between business through self-employment and other income?
Yeah, I'll answer your question, but I'm trying to mute.
Yes. But it's not copying everything.
Please, can everyone
Can you
go
guys
on
please
mute?
mute if you're not
Can
talking?
everyone go on mute if you're not talking, please? Thank you.
When they say Nigeria things, would always hear. Yeah, I'm even trying to mute everyone. I think I should have that. Okay. So from that, so the business income we have here is business from not incorporated income. Income from self-employment, income from sole proprietor activities. That's the income that is being reported in your personal income. I believe that is clear.
Okay, so what if, for example, let's say I do Airbnb. Where does that get reported? Is it under business self-employment or under other income?
So Airbnb income is part of rental income. So it will come under this other income segment. So that will come under other income segment.
Okay, thank you.
So from the taxable income, we determine and the tax credits minus the tax credits. So the taxable income, we apply your tax rate on your taxable income. Then the tax credit is subtracted to arrive at tax payable. To arrive at the tax payable. Then the tax payment is, when you receive your salary, your employer deducts your payroll taxes. So what we look at this point is all the taxes that you have paid at source, that have been deducted at sources. That's the total tax payment. So what the system does is it now compares your tax payable and your tax payments. Now, if your tax payable is lower than what has been deducted at sources, various sources, then you have a refund. But if the tax payable is greater than what has been deducted at various sources, then you have a balance owing. Now it's more of like, how much is my total? So for like in this scenario now, the tax payable is 9,9936, while the tax payment was 15K. So this person paid more than what he or she should have paid. This is the total amount that was deducted at source, and this is what he should have paid based on the taxable income and the tax credits. So in this case, this minus this will give us a refund of 5,064. So as Ella said, the goal is how do I reduce my taxable income such that my tax payable will be very low compared to what has been deducted at source. That should be the goal. Then we'll be looking at.
Here. And does it mean this guy they don't check that the values you provide are accurate?
So what values now? So there are some values like your tax, your T4 provided by employer. Those ones should be accurate. All the other deductions should be accurate. So I have some clients, not my client, but client that I am working with now, that some of them reported donations and they never had receipts, and the receipts were not genuine. Like the donations were not genuine. They just feel that government will not pick up my file for audit. So someone that did not go to school in Canada claimed tuition amounts, claimed donation, and CRA, because they run some IT codes to check for accuracy, completeness. So they know they can run codes to determine, if this is a suspicious activity or a suspicious filing, you understand? And they pick up such clients and they ask for, where is your donation receipt? Where is your tuition receipt? And the clients could not provide it. Now, the government have to now reassess the client, and the client is currently owing over $10,000. So the best thing is, let's try to report what is right. And there are legitimate ways we can reduce our taxes, which we're going to see during the course of this instruction. Now, this slide is for the purpose of those who have not, like first-time filers, people that maybe landed in Canada in 2021, and I'm going to pick one or two items which we won't discuss in full during the course of the session. And one of them is moving expense. So if you relocate, so let's assume I currently live in Kitchener, Ontario, and I get a job in Mississauga, and I decide to move my family to Mississauga. So you understand, getting a new apartment or a new house in Mississauga. As long as that's the distance between my new office and my old house accommodation is more than 40 kilometers. If it's more than 40 kilometers, I can claim all the expense associated with moving, transportation, meals during the course of the travel. If I need to stay in hotels for 3 days or a week while traveling, I can claim that. Then the carrying charges, I was going to talk about that relates to investment expense. I'm just looking at those items that we won't fully discuss during the course of this presentation. Then going to non-refundable tax credit portion. We have digital news subscription. So for some of us that subscribe to some digital news, maybe not print but digital one, we can claim that to reduce as a credit, because government is encouraging people to sign up on such instead of signing up on print subscriptions. Then the home buyers amount. So we have interest paid on student loan, tuition amount. Yeah, so this is just a snapshot of the tax credit and the deductions. But the major ones that, from experience, I know that clients usually have issue with reporting the right data will be discussed during the course of this session.
Sorry, please, what does donations figure out here?
So donations is a credit. It should be part of this slide. I think my presentation is not capturing well, but donation is a credit, and we have a full slide on this during the course of this presentation. So we'll talk about it. So now let's look at the traditional ways people use to reduce their taxable income. And I'm going to talk about one or two that's...
Sorry to interrupt you, Shay.
Okay.
Please, I just want to confirm, is there any credit for people working in sectors that are prone to be essential industry workers? Is there any credit for those?
Yeah, so as at today, I am not aware of any, you understand? But, government they have not finalized. Government is still discussing some items that relates to 2021 taxes, but as at now, I'm not aware of any such.
Either for businesses or individual. Okay.
For frontline workers.
Yeah, or people who have their businesses in essential industries. Yeah, any update yet?
No, not to my knowledge.
Okay. Thank you, Shay.
Okay. So we are all familiar with RSP, but for those people that are new to the filing system, now RSP is a deferred tool. Now, how it works is that, so let's assume my taxable income is 70K. If I contribute 10K worth of RSP, what I'm saying is that 10K out of my 70K, I want to defer taxes on that. So I want government, I only want to pay tax on the 60K portion. The 10K that I'm contributing to RSP, I want to defer taxes on that 10K. Now, the goal of RSP is that when currently most of us that were earning between maybe either 40 to 100K, our effective tax rate is high, between 25 to 30%, and we want to reduce our taxes currently. So it's like, currently I'm within the higher tax rate. I want to defer tax on some of my income, such that when I'm old, you understand, maybe my tax rate will be around 10%, 11%, then I can withdraw those funds. Then effectively the tax I'm going to pay when I'm 71 will be lower than the tax I'm going to pay now when I'm working. So it's a tax deferred tool, and it's also is a savings tool. The government is encouraging us to save towards retirement. So, but the good thing is that a lot of people make use of this. There's still another slide on this, on what people are doing currently to maximize tax deductions using RSP. And another thing we need to look at is, so sometimes we might have issue with our limits. So for RSP, we have what they call deduction limits. Then we also have what we call contribution limits or contribution room. So if you go and check your notice of assessment for last year, you will see all these numbers in your notice of assessment. Now, deduction limit relates to what you can deduct from your taxable income, what you can deduct from taxable income. So for example, for this particular client, the amount the client can deduct for 2021 is 14K. That's the amount the client can deduct. But the amount the client is allowed to contribute is a contribution room, is 5K, 5467. So you should be able to differentiate between my deduction limits and my contribution limits. For most of us, our deduction limits and contribution limits will be the same. But this client's own is different because the client has unused RSP contribution. Unused in the sense that, so for example, now, maybe this client contributed this amount in 2020, but decided because my tax rates, my taxable income this year is low, and the tax rate is low, it won't benefit me to claim this deduction this year because my tax rate in 2022 was low. I don't want to deduct it when my taxable income is low. I want to maximize my RSP when I feel my taxable income is higher, because when your taxable income is higher, you are going to pay a higher tax effectively. So the client can decide, I don't want to deduct this, so you can carry over RSP contribution you made in a year, you can carry it forward to subsequent years. So this is what the client did here. He has unused RSP of 9,096 before 2021. But because he has unused RSP, he can deduct this in 2021 taxes, but this is the amount he's allowed to contribute in 2021. Although the client can contribute more than this, but there will be penalties if you go beyond your contribution room. I believe this is clear. So you should be able to separate between your deduction limit and your contribution limit. Wow. Then moving on to childcare, I believe most of us will pay childcare for our little ones. But these are the qualifying expenses for childcare: babysitting, daycare, nursery school, overnight and day camp, summer camp. But there are some items that are not eligible. Training. So if, for example, my daughter, extra classes for her is not claimable. Vocational event for her, like piano, she's learning how to play piano, and I'm paying some people for those extra classes. Those items are not what? Claimable. If my child is attending a boarding school, those expenses are not what? Claimable. Another thing you need to note here is that is for couple, the expense can only be claimed by spouse with the lower end net income. Lower end income. So government wants to encourage people to work. So, they realize that some people, they have a 3 or 6 month or 1 year old baby. Maybe the partner is not working and is taking the child to daycare. So government is saying for such, you cannot deduct it because you're at home, you're not working, and you're taking your child to daycare, and you are not expected to claim such on your income tax. That's why it's being claimed by the lower earning spouse. Even if you put it on the higher earning spouse, the tax software will push it to the lower earning spouse. That's how it's structured. Now, but there are some.
To be fair,
Yep.
by day and overnight sports, you mean like soccer and swimming?
Yes.
Okay.
But mostly this will relate to maybe summer or when spring, during the breaks, spring break, summer. Do you understand?
Okay.
Yeah. So, but there are some instances that the higher end income spouse can claim this. For example, if the other spouse attends school during the tax year or was sick or hospitalized during that period, then for those period, they want to determine the number of months, then the higher any income can claim this. Why government is saying is that, the higher any spouse, this is the direct deduction, will benefit more if the higher earning spouse claim this expense. But government is saying that it's only the lower earning spouse that can claim this particular expense. Moving to the next one. This one is a game changer. It's one of the game changer.
Hello, Shay.
Yep.
Hello, Shay. I have a question for you, please.
Okay.
In a situation whereby my children attend, or your kids attend a private school, and the school gives you like a tax credit, where is that tax credit applicable? Is it under childcare expenses as well, or we are coming to it?
No, I'm not coming to it. So the tax credit, is it a credit? What's the name of the credit?
Some schools will say, you know what, you have a tax credit for the fees you've paid over the year. I'm just giving an example, $1,000 or $2,000.
But
so where do we file it?
Is it equivalent to the tuition amount you paid?
No, it's not equivalent. It's just a tax credit. Say because you have paid, you have paid school fees. So this is the tax, like a tax credit we're giving you.
So what they're saying, okay, I understand. So what they're saying is that let's assume I paid tuition amount of 3K, but out of that 3K, maybe 1K qualifies to these eligible expenses.
Okay.
Do you understand? So for example, now, someone that attends a boarding school, the tuition amount, so let's assume a child attends a boarding school and this child pays like maybe 5K per year, hypothetically. So maybe out of that 5K, 2K is tuition. Then 3K relates to meal and boarding. So the 2K that relates to tuition, that is the credit part. Do you understand?
Okay.
So the school can add, from what you have paid, they will identify this one qualifies as childcare expense, This one does not qualify. That's why they are giving you back tax credit. As far as you are getting the document from the school, then you should be, then this is applicable. Do you understand?
Yeah, okay. Because why I was confused when you said no qualifying expenses includes training or education costs, and that was why I asked the question. Thank you. You've clarified it now. Thanks.
Yeah.
Hello, Chair.
Yes.
Yeah. So I have a question on RRSP. Are you going to give us?
Yeah. We still have another slide on RRSP.
Okay. All right.
I'm looking at our time and.
Thank you.
Yeah. Okay. Other employment expense, as Ella said, this is a game changer since the start of the pandemic, and both employee and self-employed can claim it. And the CRA expects us to use two different methods. You can either use the temporal methods or the detailed method. So as at last year, the maximum you can claim, even if you work throughout the whole year, in 2020, the maximum you can claim on temporary flat method was 400K. I said 400K, I'm sorry, $400. But the government has increased that to $500. So that's the maximum you can get. But if you do a detailed method, you can claim as much as 4K if you can defend it. Defend in the sense that you can tabulate in Excel and show that this is the amount and this is the portion that is claimable. So what our advice you do, every one of us to do at this point, is that don't settle for this $500, because if you claim as much as 4K, you can increase your refund by at least 1K, depending on your taxable income, but at least close to 1K. So what I would recommend is talk to your HR, talk to your employer. You need a copy of this form to be able to claim it. If you don't get this form and you claim it and the CRA audits your filing and you cannot provide this document, they will reject your other employment expenses. So please contact your employer, your HR, and get this form.
Can we mute ourselves, please? There's this guy that kept coming up.
Yeah, I think I've tried to mute everyone and it's been okay. Thank you. So please get this document from your employer, Form T77, Form 777S, Statement of Employment Expenses, so that you can claim the detailed method. And basically, what they look at is what portion of your household or your house that you use for office. Either you have a common area using your kitchen or your dining table for office, or you have a designated room. You'll get more if you use a designated room. Like you're saying, you're using your basement fully for office, or you're using one of your bedrooms fully for office, you get more deduction from that. Then the next slide talks about what we can claim and what is not claimable under the work from home expenses. So most of the items.
I have a question, Shay.
Okay.
So, hey, Ryan, come down. I have a room and I'm working at home. I'm doing a full-time role and I also have a self-employed incorporation.
Yeah.
My spouse is also working at home and we're both using the same room as our office. Can we both claim that room as designated space for work?
Yeah, you can both claim it.
Shay, let me write on that question and include that if the person has like a full-time role that they are working from home, and maybe like he asked, you have a business incorporated and you're working from the same space, how can you claim that that space to deduct?
Yeah, so just like husband and wife using the same basement to work from, husband can claim in his own personal income, wife can also claim. Do you understand? For incorporated business, the law allows us to also allocate some of those expenses to your incorporated business. That's doable, yeah, it's allowed. As far as you can specify what percentage of your home. So let's assume I'm using my basement to work. So I can say that 30% of my townhouse is my basement. Do you understand? So 30% of the total expenses we're going to see on this page will be used to reduce my personal income taxes. If it's 25%, then it will be 25%. Now, these are the items that are claimable rent. Now, what is funny here is that if you have your own mortgage, you can't claim your mortgage interest as a salaried employee. But people that are renting can. So imagine, even if I'm paying $1,000 per month, in a year I will have paid 12K, which is huge for those that are renting, electricity. So many items can be claimed. But looking at items that cannot be claimed for salaried employee or personal income tax, you can't claim this mortgage interest. You can't claim internet connection that relates to your modem. You know, sometimes when we sign up to new internet contracts, they include part of the cost of the modem in what they prorate monthly, that we pay monthly. So what they're saying is that you need to isolate what you are paying for access and for the modem. Then any capital expense, you cannot claim it. Replace windows, flooring, furnace, cannot claim all those. Then you cannot claim office equipment. You understand? You cannot then.
I have a question. These things you're mentioning, do they apply for incorporated companies as well?
For incorporated, you can claim. For your incorporated business, you can claim most of these items. We're going to talk about that. But on your personal income taxes, as a salaried employee, in your personal income tax, you cannot claim all these items.
Sheye, sorry to cut in. What if you have a side business? Can you claim all those expenses under your self-employed?
So if you
understand what I'm talking about, let's say, for example, now you have a self-employed business and part of the costs include some major expenses. Can you include it under your, can you use it to reduce your net income? Thank you.
Okay.
That's business.
Yeah. So, business in Canada can either be sole proprietor or incorporated. So what you're expected to do, if I have a sole proprietor, I need to determine the net profit of my sole proprietor business. And to arrive at the net profit of my sole
about taxes. So I was doing the toilets.
So to arrive at the net profit of the sole proprietor, I can include almost all this expense directly or indirectly for the sole proprietor. But what I will now do is that because it's a sole proprietor business, the net profits will now be added to my salary income for my personal income taxes. That is clear for sole proprietor. But for incorporated business, the net profit will not come to your personal income tax. They're going to prepare a corporate tax filing separately. You understand? And all these expenses too will reduce your net profit for that incorporated business. I believe that is clear.
Thanks. Yeah, very, very clear.
So, but if you're a commission employee, there are some of us that they are full-time, either part-time, but they're also commission employee, maybe people that works in insurance or sales. They can claim property taxes, home insurance, lease on their items, lease on cell phone and other items. Moving on to tax credit. So we have what we call tax deductions. We also have tax credits. You understand? And I'm going to just talk about one or two. One of them is medical expenses. Eligible expenses must be prescribed. So if you buy drug off the shelf yourself, you just walk into Shoppers Drug Mart and buy drug. It's not prescribed, except it's prescribed by a medical personnel. Such is not eligible. Some people are going away with it, but if they pick your file for audits and you cannot provide your prescription that it was prescribed, then that expense will be rejected. Then if you pay premium on private health insurance, you can also claim it as medical expenses. Your dental expenses, of course, you can claim as medical expenses. Then non-eligible, your fitness club, cosmetic surgery is not eligible, except the surgery was recommended by the medical personnel and they said it's important you do it. Now, this is saying that not all eligible medical expenses is advisable for us to spend on in a particular tax year. So you need to look at what's my tax situation this year. Do I need to spend this if it is not urgent and important at that point in time? So for example, now, sometimes my optometrists call me and say that, oh, come and change your glasses. You understand? And if I look at my tax situation, do I need to change it? This is an example of a client that spent $1,000 on medical expenses for the family in a year, and they did not enjoy any benefit or credit for spending that amount, because your medical expenses is paid to your net income. So what CRA looks at is they look at the lower of your net income, 3% of your net income, or this amount. So what they are saying is that if 3% of the net income is more than what you spent, for example, 3% of this person's net income is this amount, and he spent $1,000. So what they will do is that $1,000 minus 1,350 is what? Zero. So in this case, the client spends $1,000 on medical expenses, but it does not benefit from any tax credits. So the advice is, if it's not urgent, it's not important, just wait and looking at your tax scenario for that year, will my net income be able to allow me to benefit from these credits? They're moving to donation.
Sorry.
Yep.
I wanted to take you back. I wanted you to actually finish this before we go back. If you go back to the page before now, they were asking there was this question that I'm having a business, I'm an employee, full-time employee, then I also have a side gig. Which of these? Can you go back one second?
Yeah, I'm back. Can you see my screen?
Okay, yes. So which of this option is advisable for what will I be it's advisable for me to take? Is it the eligible work from home or non-eligible work from, because I have other businesses I'm running as well. So we have two options here. One is for people working from home, full-time salary. The other one is for non-eligible work from home expenses. Oh no, there's another option of people that are based on commission.
Okay, that is yeah.
Okay, so
what?
My question is this: is it advisable for me to go for the one with commission, or do I stay with the one with the $4,000 limit, which is a permanent full staff?
The 4,000, okay, the 4,000 limit is not fixed. It bends, but what I just gave a scenario that you can claim as high as 4,000 depending on your home expenses. Now, you have a salaried job.
Then I have a commission job.
Yeah, you can claim this. What they're saying is that you can claim this or this. Then you can also claim this. That's what they're saying if you have a commission job.
Okay.
Do you understand?
Okay.
Donations. Now, the message here is that you can carry forward your donations up to 5 years. So if I make a donation of maybe $200 in a year, it's not recommended to claim that donation that year, because $200, the impact on your taxable income, it will reduce your taxable income by 15%. 15% of the amount, 15% of $200. Do you understand? But if the amount is more than $200, then you can get as high as 29%. So it's recommended that if the total donation in a particular tax year is lower than $200, you can carry forward for 5 years. Then another thing is that couple, husband and wife, couple you can recognize donations for a single taxpayer. So for example, now, let's assume in my church, I donated 3K in a year or 5K, and my wife also donated 5K. So the total donation for the family is 10K. It is advisable because it will be beneficial, more beneficial to the couple with the spouse with the higher earning income. You know, we can say that, oh, my wife can say that she wants to also recognize such on a tax filing, but it will be more beneficial to us in terms of the impact on our taxable income if the spouse with the higher earning income claim such. Then you guys can always discuss on, oh, if I put this on my tax filing, this is the impact, then I can give you that difference. But it will be more beneficial for the spouse with the higher earned income to claim donation.
Oh, Shaya, just a second here, please. So for the donations there, does it mean that anybody, I mean, if either myself or my spouse make donations, either of us can claim that donation?
Total amount, yes, total amount, yes.
The total amount.
I can split it. If both of you have a total of 10K, you can say, oh, 7K should go to the couple, one of the partners.
Thank you.
You can split it. Yeah.
Thank you. Thank you.
Then another, this is a refundable credit, is Canada training credits.
Sorry, Shay.
Yes.
Shay. Please, can everybody put their mics on mute? Can we all mute? Because there's a lot of interference.
Shay, if you can give me the control.
Everyone, please be on
it.
mute.
Okay.
Thank
If
you.
you give me the control, I can help you manage it, and watch out for that.
Is that Remy?
That's Tony.
Tony, okay. I'm trying to ensure this card. Okay. Oh, this is hiding here.
Let me log out and log back in with the name.
Yeah, I think, where is the participant? Apologies for the delay, trying to.
Can you hear me? ONNIE. You're showing number one on my list.
Number one.
I don't know what number it is on your list, but TONNIE.
Yeah, I think I need to.
Or should I make it Anthony so that?
Okay.
Just find.
Okay, Anthony. What's it? It start with the name starts with what, please?
TONNIE.
Okay, I think I've seen it.
All right, cool.
Someone snoring. Oh my God. And they didn't put themselves on mute.
Oh, dear,
Please,
Baba.
let's
Okay, so
I couldn't,
yeah,
I
Tony,
couldn't help myself.
Tony,
Oh my God.
Yeah.
yeah, I've made you
Tony, please
host.
mute everybody, please.
Good. Thanks. Okay. There we go. All right.
Okay, we're on Canada training credits. Now, this credits was introduced last year. Can you all hear me? Hello?
Yes, we
Hello?
can. Yes, we can.
So this was introduced last year, and eligible training expenses. Sorry for that. So eligible training expense can be claimed, but the restriction around this is that you can only claim trainings done by professional bodies in Canada or any certified institution in Canada. And you can see your training. Hello, can you see my screen?
Yes, we can.
Okay. The Canada training credits, eligible training expenses are done by professional bodies like maybe CPA or any Canadian professional institution or any institution in Canada. So, but for you to see what is available, like institutions that are accredited by CRA, you can go to CRA website to see the details. But this is a snapshot of a notice of assessment where you can see your training credit. Like this is saying your Canada training credit limit for next year is $500. So it's $250 per year. So for 2 years for these clients became $500 and it will expire at the end of year 65. So this is just to encourage workers to maybe enroll in some trainings, you understand, to empower them. Yeah, are we together? Hello?
Yes, we
Yes,
are.
we have.
Yes,
We
just
can
go
hear you.
ahead. Right on.
Yeah, so this slide talks about taxes in the developed world. That nothing is certain in this world except debt and taxes. When you make money, you pay taxes. When you spend money, you pay taxes. Even when you save money, you pay taxes. And it's pathetic that when people die in this part of the world, there's what we call disease tax filing. When people die, what the government does is that they will assume deemed disposition. Deemed disposition in the sense that all your properties, except properties that jointly owned by couple, all your properties will be assumed to be disposed. So let's assume you have 2 properties. One is jointly owned with your partner, but the other one, you bought it maybe when it was 500K and the taxpayer dies in 20 years' time and it worth $5 million. Government will collect tax on that property. Government will assume that that property you have has been disposed, and assuming it has been disposed at fair market value, what is the capital gain? And they will expect people that inherit that property to pay tax on it. That's why we need to structure our investment in such a way that we reduce our taxes appropriately. Now, this is the most interesting part of the presentation, looking at the modern ways people are using to reduce their taxes. People are thinking differently. How can I reduce my taxable income? And the first one is RSP optimization. Can you please see my screen? Hello? Hello, can you hear me?
Yeah, we can hear you.
Yes, we can
Yes,
hear
I see
you.
your screen.
Okay. Now, there's what we call RSP tax year. RSP tax year starts from February, for example, for 2021, the tax year starts from end of February for RSP to March 2022, March 1, 2022. Now, what this is saying is that even if I contribute RSP to my RSP in January 2022, it will still count for my 2021 RSP contribution. So the tax year for RSP starts from February to March. So you can still contribute to RSP in January or in February, even till on the 1st of March, and you can still deduct that from your taxable income, your 2021 taxable income. Now, the recommendation is that by third week in February, you should have an idea of how much will I be getting from the government in terms of tax refund. Am I getting enough? Can I reduce my taxable income to get more from the government? And this is one of my clients' example, you understand, for last year. So as by third week, we simulated for the clients and we said, okay, based on the client's scenario, this client will be getting back 4,000 from the government. And the client says that I want to get more from the government. And I want to also increase my savings. I want to get more from the government. And I want to increase my savings. So the client does not even have enough savings. And the client, based on what is beneficial, the client went to his line of credit to take money to buy RSP. So this client bought RSP worth of 15K. And look at the impact of buying RSP worth of 15K on his taxable income, on his tax refund. The refund will increase from 4,320 to 10,160 with an increment of 5,840 for taking that decision. Now, this client has assets the client has assets worth of 15K. He borrowed money to invest in this. I lost my pen. So in terms of net worth, the net worth of this client increased by this amount for taking this investment decision. I lost my presentation. Please excuse me. I believe you can still see on my screen. Can you see my screen?
Yes, we can. Just go ahead.
So by taking this decision, the network of this client increased by almost 5K. He has 15K in RSP investments. He increased investment by 15K and additional refund of almost 6K for taking this decision. Now, this is how the rich people grow their investment. Because if this person is talking to maybe to a lending institution, that 15K worth of RSP is part of his savings. He has increased his network by this amount, has a savings of 15K. He increased his refund amount by almost 6K. And within a year, he can pay off the line of credit, the fund he got from the line of credit. So some of us even have line of credit at 3%, 2%, 4%. Even this scenario, my client, his line of credit was 6%, and his net was still increased by almost 5K. So the recommendation is that by third week in February, simulate your taxes. How much will I be getting from government? If I buy this worth of RSP, what impact is going to make on my refund? if he has not taken his decision, this free money of 5K, he won't have gotten it in 2020, in the year 2020. So please, you can look at this and see how it will benefit your tax situation.
Sorry, a quick question.
Okay.
What of people that have investment in RESP? Does that count as well?
No. So RESP is not a tax deduction tool. So you can't deduct that from your taxable income. It's only RRSP that you can do, and some other tools.
Can you deduct contributions to RESP?
No.
Can I ask, please?
Yes.
The things you discussed earlier that can enable one to get deductions from their taxable income that has the effect of reducing your taxable income. When you want to apply for a mortgage, which one will the mortgage brokers use, or the banks will they use? Is it the one in your offer of employment, or the reduced one?
They look at the gross. So they look at the gross income, not your taxable income. So my gross income could be 70K, and my taxable income could be 30 or 40K. So they look at the 70K, your gross employment income. Yeah.
Okay, thank you.
Yes.
Okay, so about spousal RRSP, I know that's another method that you can use to reduce. So how does it work? Does it really mean that the spouse, the other person, the significant person, probably must be a low income earner, or I can just decide like, okay, fine, I want to reduce my tax. I can just, okay, I know my wife has a room, I can just transfer into her. Is that how it works?
Yes. Now your wife, let's assume your partner has a room, has enough contribution room.
Okay.
So you can contribute into your partner RSP, but it's still pegged to how much you can deduct that year.
Me personally can deduct, right?
Yes. So you need to, maybe you can deduct. Let's assume this is your own notice of assessment for 2020. So this is your deduction limit for 2020 on the assumption. Now let's assume you have contributed 14K, and your wife still has room. You also contributed maybe 10K. So in 2021 tax year, you contributed 22K. But this is how much you can deduct as a taxpayer. Do you understand?
And I've maxed it out myself. I've maxed it out for myself. So I can't transfer to her since I've maxed out my own
no,
limit.
You can. What should influence your contribution is how much can I deduct?
Okay.
This is what should influence your contribution. So let's assume I can deduct 14K and I've already contributed 14K. It means that for that tax year, I can't deduct more than this 40K. Even if I contribute 10K towards my spouse RSP, for that year, I can't deduct more than what? 14K. Although that 10K that you cannot deduct in 2021, you can carry it forward to the next tax year.
Okay. I see.
So my question is, the way you painted this scenario here, does it mean as long as I draw down on my line of credit, it's for any form of investment, it affects my taxable income for that year, or I have to be keeping that money in RRSP particularly? I don't know if you understand my question.
So yeah, I do. So you can withdraw that money after you have filed your taxes, or after the tax year, after the RSP tax period.
Okay.
So like this client now can decide that, oh, I don't need the money in RSP. I've enjoyed this free 58K.
Okay.
On March 2nd, I can take my money out. but you'll be charged taxes on RSP withdrawal. But if you manage your taxes well, so let's assume and decline withdraw 15K March 2nd, and they might charge him 20% tax on this. But you know that 20% tax will also be part of the total tax you have paid at source for the next year. So you will still get your money back because that money will increase the total tax you paid at source for 2022. And when you're filing,
sorry to cut in. I'm only just looking at the scenario here. You said before the net income was $57,000.
Yeah.
Right? Okay. So how come the net income became $42,000? Is it that they went to check, they checked his line of credit and found out that he actually drew $15,000 from his
So what reduced the net income from 57? Oh, okay, then the net, no, I think there's that reduced the net income from 57 to 42 was this RSP contribution. So RSP will reduce your net income from your total income. So the RSP contribution of 15K reduced the net income from 57 to 42K, and effectively reduce your taxable income from 56K to what? 41K, and your taxes will be calculated on this. That's why there's an increment in the refund amount.
Okay, that makes sense.
That is
Shay,
clear.
I have a question, please. So let's say that within this period, being like January, February, let's say maybe you got 5,000 in your RRSP.
Okay.
Let's say it's maybe your bonus that you put in your RRSP, right?
Yeah.
And you decide to take that money out for something, maybe to pay for school fees, tuition, those allowable reasons to withdraw from your RRSP.
Yes.
Let's say you take that 5,000 and your contribution room for the year, perhaps say is 3,000. You got 5,000 as your bonus and you took 5,000 for whatever reason, school or whatever. How will that impact your tax?
So what they will be looking at is the nets. So it's like in the same tax year, I contributed 5K. In the same tax year, I withdrew 5K. So the net is what? 0. So the net contribution is 0. So you cannot deduct anything. I believe was I able to answer your question?
Oh, I see. So it may be better to not touch that money until, say, March 2nd.
Yes.
That's when you can get the full deduction.
Yes.
Okay. And since your allowable limits, like your contribution room for that tax year was 3,000. If it was 3,000 and you had 5,000 from your bonus, how do you manage the 2,000 that is above your contribution room?
Yeah, so I even think for RSP, you can over contribute. I think there's a plus or minus 2K without penalty. Do you understand? But what is key is even if you over contribute and you don't have enough deduction limits. So this is what is key to CRA. How much can you deduct? If you over contribute, they can charge you penalty. But what is CRA is particular about is your deduction limit. You cannot deduct more than your limit. But if you over contribute within plus 2K, they will still waive the penalty. But if it's more than that, they might charge you penalty.
Sorry, Shay, I'm still not clear on that. Let me give another example and say your contribution room based on NOA is 3,000
Okay.
for that year. And let's say you got bonus of maybe 10,000
Okay.
that went to your RRSP.
Okay.
How will you treat that kind of scenario?
Now, what is your deduction limit?
Okay, that's something to know. I don't know. I haven't seen that deduction limit thing before. So you mentioned it has to be in the NOA.
Yeah. This is a snapshot of what you will see. Yeah, I think we need to see, I will need to have an idea of the deduction limit before I can advise you what you can do. Thank God we still have time before the end of February to take decisions. So you can connect with me later.
Okay, thank you.
You're welcome. So moving on. Now, these are the big guys.
Shaya, sorry, do you really want, just one question. I just need to clarify something. So, for instance, if you drew out of your IRSP to do a purchase of a house, for instance, which is allowed, right? And
first-time home buyer.
First-time home buyer, yes. And you buy a house, for instance, and you drew out of your IRSP. Is it advisable, for instance, what impact is it going to have on your tax? Is it advisable for me to pay back that money right now, or I wait? Because if I can afford to pay back that money, is it advisable right now, or I wait? What impact will it have on my tax? Any ideas?
Yeah, the government gives you enough time to pay back. They
Correct.
can give you up to like maybe 5 years. You understand? There's no penalty.
Yeah.
But just if you withdraw from it, you want to see what is my net contribution for that year. You understand? Because it's the net contribution that you can deduct in your to reduce your taxable income. And another thing is, as a first-time home buyer, you're entitled to the home buyer's amount of 5K as a tax credit. So that one is huge for the taxpayer in that year you got your first home.
Okay, thank you. I will. Yeah. Okay. Yeah. We'll. I think I'll need to connect with you on this later.
Okay.
Thanks. Appreciate it.
Yeah. Moving to the big guys. I believe you are familiar with these names, the likes of Elon Musk and Jeff Bezos. They don't typically, on the average, some of them don't even pay any tax to the government, and they earn billions of dollars. They worth billions of dollars. So what are they doing? They are investing in financial assets. Looking at Apple between 2018 and 2021, Apple value tripled in terms of grew 300% between 3 or 4 years. And even looking at the stock market last year, the top, despite the fact that there was pandemic, stock price still outperformed most other assets, like S&P 500 grew by 26%. The Dow Jones also grew. So on the average, the three of them grew by 20%. So what these people, what they do is they borrow to invest. Like, so imagine if someone like Elon Musk wants to invest in stock they have a target for every year. This year, I want to invest maybe $5 million in the stock market. And at the end, they will earn dividend income. Their network will grow up, and they won't pay any tax on that dividend income. And they have earned the income. And this is what they do. So look at it. One of my clients that took 55K last year from his line of credit to buy stocks. At the end of the year, the worth of the stock was around 65, from 55K to 66K. The stock value grew from 55K to 66K. And he earned a dividend of around 1,185 on the stocks. It took, for most of us, we can easily get money from our line of credit. It took the 55K from his line of credit, and the interest he paid on line of credit for a whole year was 2,200. So what the tax system will look at is the income you made from the stock and the expense, we call it carrying charges. So it made So he made 1,815 from dividends. Then is incurred 2,200. So in terms of accounting, the net profit on this investment from dividend income and the expense, the debt he paid to service the line of credit was 2,000. So the taxable income on this investment of 55K will be zero. So he's not paying taxes on the dividend income. He has made almost $2,000 on dividend income, but that is not even, the cost here is that this person has grew his network by 66K. So imagine someone like Elon Musk doing $1 million, $1 million, how much it will have grown up. And when they are talking to lenders, this is what they have in their investment asset. Just like a person that bought real estate. This is the value of my house. This is the debt I'm owing. This is in my network, the market value of the real estate minus how much I'm owing the bank. So the recommendation here is that we need to play in these markets. We need to invest in financial assets because the interest you pay, they don't use their money. They borrow money to invest because they know that they will use the interest expense on that borrowed fund to reduce the income they make on the investment. So because they have the intention of not paying anything at all. So it's a good investment strategy. You can start with 10K, 20K, 30K, and that's how they grow their investment portfolio.
Excuse me.
Can we move to the next slide?
May I ask you a question?
Yes.
Yes, it will be advisable to play in this market space. What would your advice be if you are investing at a bubble and then the market is now shrinking?
The market will always go up and down.
So you should play long and not short trade.
It depends on the strategy. You understand? If you're not an active person in the market, you understand? You know that effectively, the equity market will go down, will go up. But effectively, at the end, the net impact is that the market will go up.
Okay,
do you understand? So just look at Apple within this period. And there's some investment that mirror the performance of all these top performing stocks like ETFs. You can buy ETFs, you can buy index funds that mirror all these index, and they will earn the average return on all these assets. Then I think the key one here, another key message is that if you are attending this session and you only have a salaried income, you are only working for the Canadian government, and numbers, data can prove that. If you have only salaried income, you don't have a sole proprietor business, or you don't have an incorporated business, it's like you are just working for the government, because your taxable income will be high. And most of all these wealthy people, some of them has 3 business, 4 business, but the recommendation, as earlier said, is that sole proprietor business has its own benefits. Incorporated business has its own benefit. I tell my clients is have both and use both to maximize your taxes. So, for example, someone that just started a business and realized that business is struggling, he can have, and is a sole proprietor. So before applying the performance of the sole proprietor on his taxable income, his refund was just 4K. Then putting in the numbers of the business, it has a negative business of net profit of 7250. For you to do this, you must have documents to support your claims, like because this can trigger audit, and you must be able to show CRA that, oh, this is what I make in my business. These are the receipts to show all my expenses, and this is the net profit on my sole proprietor. So with this is like effectively saying the person contributed, it has the same impact like contributing 7250 as RSP contribution. So the taxable income, the net income of this person will reduce. Do you understand? And throwing in the business performance, this person has an increase in his refund by $5,300. I'm not saying that we should work towards ensuring that our business make negative income, but what I'm just saying is that it's good to have a sole proprietor business, also have an incorporated business, and you can use both to effectively manage your business. So, for example, you can ask your question.
So does it mean that that guy that has side gig, making money from his salary and making money from his side gig, can make deductions at the end of the year because he doesn't have a registered sole proprietorship or incorporation?
Your sole proprietor may not be registered.
Okay.
So you can have a side gig that is not registered, is still a sole proprietor.
Okay, and we're able to throw in as much expensive that you can prove, right?
That you can prove. That is you can prove. And you might not have 100% proof for everything that is reasonable, such that when they come in, they see the numbers is reasonable. They don't ask for additional information. Do you understand?
Okay.
So it should be reasonable.
Sorry, Shaya, let me ask. So, you just said that sole proprietorship doesn't need to be registered.
Yes.
So let's say I'm doing Airbnb, because I see Airbnb here now.
Yeah.
Let's say I'm doing Airbnb in my house. And I don't have a sole proprietorship business that is registered or, anywhere. There's no name to it. It's just me doing my Airbnb gig in the house. Does that qualify?
Yeah, so for Airbnb, it's reported under rental income. So even for personal income taxes, you will see rental income, you now see net rental income. Your net rental income can be negative, and it can reduce your taxes like this. But for it to be negative, as earlier said, you need to be able to support your document, because it will most likely trigger audits. If it's negative, maybe by 1,000, 2,000, but if it's 10K, 15K, then it can trigger audit. So you should be able to support with document. So your Airbnb income.
I can take out 10,000 from my incorporation and say I use that for expenses without proof, and that will be fine.
Without proof, you should be able to
show the proof.
You need to show the proof.
Like
I have some
proof.
So I have some proof from say food I've been buying, maybe from gas.
Okay, gas, yeah. Yeah,
or,
so
you know that for the entire year cannot be up to 10,000.
Yeah.
And must the expenses have taken place after the business was registered? What about expenses that maybe you made before you registered the business?
Yeah, I understand that. Yeah, you can have expenses before registering the business, but should be reasonable. So do you understand what I'm trying to say? Maybe let's assume before you register a business, you engage a professional to help you with research, business plan writing, and some of that stuff. Do you understand? Or maybe you need to maybe pay for a membership before you can start that business, all those items. But as Ella said, it should be reasonable, then such that when they come for audit, you should be able to support. Because if your expenses are not reasonable and they call for audit and you could not defend it, CRA will flag your profile. And when your profile is flagged, they mention that this client is a suspicious client. Every year they will be looking at your filing. and you don't want to, it's not advisable for you to be categorized by CRA because they will just be looking at what you are filing every year based on past historical experience with a client. Okay, moving to the next slide. The next slide just talk about incorporated business. Now, for you as an incorporated business, there's always how do you, as a shareholder of an incorporated business, do you want to pay yourself salary or dividend? Some people will prefer the dividend because dividend as at the end of, so let's assume I have an incorporated business and I believe I should be getting like 3K monthly. If I push that through a payroll system will reduce, deduct CPP, deduct pay taxes. So I'm going to end up with a lower monthly net cash flow. Maybe out of the 3K gross income, I might get like 2K at the end of the month. But if you pay yourself dividend, you will get the entire 3K that month. Then effectively, because it's dividend, apart from dividend as what they call dividend tax credits. Apart from dividend, I also enjoy the dividend tax credit that will reduce the net tax I'm going to pay on my dividend. For salary, there's no dividend tax credit. So ideally, when you pay yourself salary, you have a higher effective tax rate. But the flip side is that it depends on your situation. Let's assume I want to get a mortgage, first-time buyer. They want to see your T4, your pay stub, and the likes. They want to see that you have a higher gross income. So for you, your dividend will not show as an employment income, but your salary will show employment income. Then, based on experience, dividend might end you owing the government at the end. But for salary, because you will have paid more taxes at source, you understand, you most likely get a refund. But what we always advise our clients is you can do a mix of between dividend and what? Salary. You understand? Maybe 50-50% or 30-70% based on your tax scenario. Then another way incorporated business can reduce their taxable income and also make it beneficial to the shareholder is what we call a pension plan. So let's assume now I own an incorporated business and I need to save towards my retirement. You understand? Just like we are saving towards our RSP. I can use the income of my incorporated business to pay for my pension. So like I'm making money from the business, incorporated business, but I'm saving as a shareholder, I'm saving towards my retirement. And whatever I pay, let's assume in a year, I pay $10,000 as retirement savings for the shareholder. That 10K will reduce the taxable income of the business. So that is beneficial to the business. It's also beneficial to the shareholder because I'm using the income of my business to save towards retirement for me. Do you understand? So that's another thing.
Sorry, can you combine your tax limit as an individual with the tax limit with an incorporation? Say I have 5,000 and I also have an incorporation. Can I pay?
Are you talking about your RSP limit?
Yes, and the one they just described now, are they the same or they're different?
Yeah, because effectively you're paying into your RS. Yeah, they're the same.
Yeah. So that are you done, Manasseh?
Yeah, I'm done. Yeah.
Okay, so that's the next question I wanted to ask. Okay, for my incorporated business now, I need to open a private pension account that will make money. What are these private pension accounts? What could they be? Is it like RRSP? And if yes, what other options?
Yeah, so based on the last question, you might not want to follow RSP because of limit or contribution issue.
Okay.
I'm not a financial advisor, but I know that apart from RSP, there are other retirement tools. You understand? that can also work the same way. So the goal is I want to save towards RS because the amount contributed by the employer, the business in this case, the individual cannot claim it. The individual can only claim the amount he contributed. Do you understand? But the good part of this strategy is that you can use the business money to save towards retirement. It might not be RS, it might be another retirement fund, but at least you are indirectly saving towards your retirement and you are reducing the taxable income of the what? Business.
So when you want to, at the point where you now want to withdraw from the pension plan, is that where they say, this is what you can take and this is what the business owns?
No. If the business, so if today I work for a business and they paid, I work for the business for 3 years and they paid like 20K into my retirement savings. If I leave that business today, it's my money. It's like salary employee benefits. They have written it off in their P&L, so it's your money.
Yeah, the confusion there is because the owner is also the one paying himself.
But
They are
the
two separate
strategy,
entities. The money you are paying to the private pension plan is the money for the employee that is being paid for. That's just it. But it helps the business to reduce the taxable income.
And in this case, you might even be the only employee.
Yes, that's where the confusion was coming in initially. I guess that's why the question.
Okay, but
it became clearer.
Yeah, but I believe it's clear now. Then the third item here is business use of vehicle. So as a business owner, as a sole proprietor or incorporated business, if I have a car, I use my car for personal and for business. So the tax law allow me to deduct the business use of my expenses. So let's assume in a year, I drove maybe 50% of the mileage is for personal, 50% is for business. And the total expenses I use in managing my car, gas, maintenance, repairs. Even if I have repairs, accident on the car, and I have to fix it, it's part of it. The total in manage car wash, everything spent on that car, 50% of it, as a sole proprietor or incorporated business, I can deduct it using what they call business use of vehicle. But another flip to this is what we call the tax-free automobile allowance. And this amount can give you higher value. So let's assume I can claim that I drove my car 20,000 kilometer mileage in a year. Based on the CRA approved rates, with that 20,000 kilometer, I can pay my employee almost 10,000, 10K worth of allowance, tax-free automobile allowance. So what this is saying is that this allowance will not be charged. My employee will not be charged for this 10K. So I can pay myself as the shareholder. Do you understand? But the whole goal is I want to reduce the taxable income of the business. So I can reduce my taxable income by 10K by paying the shareholder this tax-free automobile allowance. And from most client scenario, you get more from this tax-free automobile allowance than using the business use of vehicle approach. Then I think on this same slide to the far right, we have what they call GST optimization. So what we recommend to our clients is, even if you are a small business, the law requires you, if your income exceeds 10K, 30K in a quarter or 4 consecutive quarters, if your gross income exceeds 30K in a quarter of in 4 consecutive quarters, it exceeds 30K, you are expected to register for GST. But we are saying that as a business, either sole proprietor or incorporated, do you understand? Even if your income is not up to this, you can register for it and you will benefit from it. one of my clients' scenario that the sales was around 29K and total expense was around 26K. He received HH's GST on this gross income and he paid GST, HST on this 26K. So assuming this client does not have a GST, is not registered for GST, he won't have gotten this free money. It's like getting a free money from the government for helping them to collect taxes. So applying the GST collected by this customer, he collected GST of this amount on sales, and he paid GST of this amount on his own expenses. When you buy something on behalf of your business, you pay GST, what we call your input taxes. So you can claim this amount. So effectively, because this client is not mandatory for this client to register for GST, but this client register for GST, and effectively, it gained almost more than 3K for just registering for GST, collecting GST for government, and it can claim. So when you collect GST from government, you can claim the GST you paid on your expenses too. So if your business is small, I would recommend, and you're not registered for GST, please go ahead and register for GST.
Okay, Shay, I have a question here, right?
Okay.
You have a business, right? And every month the customer pays you GST, and that GST is remitted to CRA in return, right?
Yes.
Are you telling me now that when I'm filing and I document my GST, right, paid on my expense, I could get a refund from government?
When you file GST filing is different from our personal or corporate income taxes. So we'll file for GST separately. So when you file for GST separately, you will report this number, then you report the GST you collected on your revenue, you report the GST you collected on your purchases, and this is the net amount that will come back to you.
Okay, so when you say report this amount, for me, I've been sending the money to CRA already on a monthly basis. The GST I receive.
But what about the GST you paid?
I've not done that.
Yeah, so some clients, because they don't.
You have to remit your GST, and depending on your situation, it can be done quarterly or
yearly,
or
monthly.
every month.
Yeah, it depends on it.
Okay.
So it depends on your gross income. You understand? So if your gross income is huge, CRA wants you to do that monthly. If not, it could be quarterly, or you can just say you want to do at the end of the year. So for you that you have been doing it monthly, when you now file your GST for the financial year, they will ask you how much have you paid by installments. So that will be factored in to determine how much you should claim. But for you need to go and check your documents, the GST that you have paid on your expenses.
Okay.
That's the only way you can benefit.
Exactly. I wanted to say that if you are doing input and you are not doing output, you are indirectly cheating yourself, because it should be the net, right here.
Yes, the net that you remit back to government.
Exactly. So if you are doing input and you are not doing output, you are dashing government money. That's what it means.
So go and check your record and see the GST you have paid on your purchases for the business.
Exactly.
Okay. Fantastic. Thank you. I understand. But I hope it's not too late. Can it still be achieved?
Yeah, of course, it's not too late.
Okay. Thank you.
Yeah, I think the next is who we are as Accurate Consult. So these are the list of services we do for our clients. We help clients to file personal and business. And we know that there are a lot of free tax software in the market, but from experience, what we charge you and the additional value you will get from us filing for you, you will see that in the difference in your tax refund. We also help businesses to file GST, to register businesses. We can always advise you for this type of business. do you want, you should go with sole proprietor or incorporated business? And we can also help you to register your business. Then we also help businesses with business plan writing. You want to set up a new business, you want to apply for a grant, and they need a business plan. We follow the standardized business plan writing acceptable by lenders in Canada. We can also help you with bookkeeping, either monthly or quarterly, so that you don't need to wait till. So there are some. Hello. So we have some clients that they want to file their taxes for the year and trying to collate their business record. Sometimes it might take us a week, 2 weeks, a month to do that. We can help you to do monthly, quarterly bookkeeping so that by the end of the year, it won't be difficult. It won't take longer time to get your financial records. Then we also, for small businesses like from shareholder, they want to get a T4 at the end of the year on their incorporated business, or for if you have a small business and you have 2 employees, 3 employees, as the case may be, we can help you set up a payroll service at a competitive rate. Then for incorporated business, for you to file your incorporated business, and this is what I see for some clients that I've worked with, that work with some accountant in prior years. They give the accountants a profit and loss, and the person will just, I don't know, come up with a balance sheet without even their knowledge. And if you don't have an idea of what is in your balance sheet, see how it can trigger audit, in the sense that there's one client I saw in his balance sheet, like 20,000 within earnings. It means that you have accumulated earnings in that business. And the client told me that what he just gave to the accountant was just P&L, but he does not know how the accountant came up with the balance sheet. So, but normally for you to file incorporated business, you need at the minimum a balance sheet and a P&L. Do you understand? It's easier for you to draft your P&L yourself, profit and loss, from your total income minus total expense. You can do that. But a balance sheet, you will need an accountant or someone that understands how it works, because there's a relationship between your balance sheet and your P&L and your equity statement. Then we also provide consulting service and advices to clients. Yeah, that's the end of the presentation. We have questions. Hello.
Yeah, I have a question. So
before question and answer, please.
Okay.
I on behalf of the admin of the FBN Elephants, we want to thank you so much for this wonderful presentation. I believe all of us, we are taking at least one thing from this. I thought I know a little bit about taxes and all that, but apparently I still have lots to learn, and I've gained lots from this section. Once again, thank you so much for letting us tap from your wealth of knowledge, and want to encourage us all. Tax filing season is here. Please, let's patronize one of us. He has a business that is into that. If you need someone who needs to help you file your taxes, don't take that little money, don't take it to an external person. This is one of us. Let's patronize them. Once again, Shaye, thank you so much. God bless you. So we can now take question and answer.
Thank you, Sean. Any other question, comments?
Can you please share your contact, Shaye?
Okay. Okay, this is my. Yeah, you can send me message. I'm active on WhatsApp, so you can send me message. I will surely respond to you, or SMS. You can call me on phone.
Can you put the number on this slide so that everybody will see?
Okay. My number is 226. Oh, don't mind. 226 899 Don't mind my pen, 6109.
226-899-6109.
Yeah, 899-6109.
Or if for any reason you didn't get it, you can always contact any of the admins and we can always share his contact with you.
Yeah, I'm going through the charts. Any other question? Because I've spent a lot of time, but
Yes, my question is, say you have a business, right? And at the end of the year, there is, say, 10,000, 20,000 as profit. Do you want to report that to CRA as profit, or you want to use that money for something else?
if you have a net profit, you must report it to CRA. But when you maybe discuss your situation with an accountant, they can look at other ways you can reduce your taxable income that you have not. So let's assume now someone drives his car for business and is not claiming any vehicle deduction. Do you understand? So as far as his right is legit, we can, or any good accountant can look at your scenario and advise you based on the number you have declared. These are other legal ways you can reduce the taxable income so that you pay little or no tax to CRA. And because if you look, making reference to the previous slide that we showed, on the average for incorporated business, federal, you pay like 9% on your taxable income. For province like Ontario, maybe additional 3.2%. Like that's close to like 11 or 12% on your taxable income. So you want to reduce it as much as possible so that you pay less to the government.
Hi, Shay. I have a question.
Okay.
Okay. How does this work for a business that has to do with exportation? Let's say someone runs a business that you source goods from Canada, but exports the goods for sale outside Canada. How does this work in terms of filing taxes and in terms of CRA? How does CRA interpret this? What is such person who runs such business? How do they do in respect of taxes?
Yeah, and just like a typical example of people that export cars to Nigeria or Africa to sell.
Yeah. Or other goods, not just cars, other goods too.
Yeah, so for such, you understand, you're supposed to report the revenue from such business. Even if
the revenue is not in Canadian dollars, even if it is, let's say, in Nigerian naira.
You convert to Canadian dollars based on either Bank of Canada exchange rates or any exchange rate you can derive. Do you understand?
Okay, that means you have to self-declare the profit you make.
Yes, you have to self-declare. You are expected to. Now, you export these items. The record of your export is with some agencies. Do you understand? Or some other businesses in Canada.
Yes.
And let's assume the person now reports that he paid you this amount. You want to claim GST from the government. Indirectly, that person has reported you to the government. Do you understand what I'm trying to say?
Yes.
So it's always advisable you self-declare, but you should do it in a way you can defend in terms of this is the income you made, these are the expenses you paid, but everything should be translated back to Canadian dollars.
Okay, now another question is, most of the sourcing, most of the buying of things for these exports, the sellers always prefer to be paid in cash. How can you, in terms of reporting your profit, your income and all that, how does this work?
Can you please repeat that question? I'm sorry.
Okay, I said when sourcing some of the goods from Canada, some vendors prefer to be paid in cash. How do you how can you balance this? Pay the expenses you made purchasing the goods in cash, and then the income that you also have to self-declare after selling. How does this work with CRA?
I understand that scenario, and some of my clients who have that issue. Now, if the seller insists that you should pay cash and you don't have a choice, you can't buy from any other source, then you pay cash. You understand? So, but when you're declaring, there's tendency that I made on 50,000 worth of goods, I only pay tax GST on 40K or 30K worth of that 50K. So it's what you pay tax on that you declare to CRA on in your GST filing. I believe that is clear.
Okay, not really. Not really. Okay, so that means I also have to, when accounting for all the income and expenses I made for the business, I have to declare the purchases I made in cash and also declare the income I made from it. Is that what you mean?
Yeah, in your own record, financial record, you'll be able to identify these are purchases in cash that I did not pay GST on, and these are other purchases I made that I paid GST on. So the one you can claim back is the portion that you paid GST on.
Oh, okay, I understand. Okay. So it pays a business to actually make purchases that are on record.
Yes.
Okay.
But for those purchases you made in cash, you do not pay GST on it. So if you are not able to claim it, there's no loss. Do you understand? But the goal is that those additional GST you paid on your purchases, you should be able to claim them back.
Okay, thank you.
Yeah, I have a question. Yes, someone landed in Canada in April last year and never filed tax before. Now, like this person now will not have a contribution room. So if you contribute towards RSP, you might not have that benefit in 2021, but your contribution can be carried forward to 2022 tax year and you can deduct it. I believe that is clear. Mr. Khan, any other question?
Yes, Chair.
Yes.
Sorry, for a salary earner that owns a property, the property taxes, are they a tax deductible?
For a salary earner, no.
Yeah.
No. But for a business owner, sole proprietor, incorporated, yes. So can you see one of the benefits of having a side business? So many businesses you can do in Canada. Just look for one that you can do.
Okay, but for other training, like maybe professional subscription, like CPA, ACCA, those ones are.
Yeah, annual professional dues. Yeah, you can deduct all those ones.
Okay.
As long as you are the one that paid for them. If it's paid by your employer, you can't deduct them.
So there's nothing that can be deducted for principal private residence.
No, we mentioned it earlier. The slide I talk about work from home expenses.
Okay.
You can claim electricity is so many. It's part of the slide. I'm going to share the slide. You understand? So many items that you can claim as a salaried employee, even from working from your own principal residence.
Okay.
Or you can't claim property taxes. It's only a business owner that can use property tax to reduce their business income.
Okay, thank you.
Oh, okay, Shaya. This is Shayi. Please, I have a question.
Okay.
You mentioned earlier that a business does not necessarily need to be registered. I want to believe that applies to sole proprietorship, right?
Yes.
Find out that is there a time lag or the time limit between when a business can operate without being registered? And then if there's no time limit, would that exclude one from all the other benefits, or are there other benefits that one will be missing as a result of not being registered?
The only benefit is maybe if you are not registered, you cannot apply for grants, government benefits, and the rest as a sole proprietor. That's only, you won't be able to enjoy any government benefit if your sole proprietor is not registered. I believe I was able to answer your question.
Yeah, you did.
Okay. So any other question, as a salaried employee and I work from home, does it mean I can claim all my? Yes, if you pay rent, you can claim all your rents as part of the employment expense. But for you to claim it, you must get Form TT7X from your employer. Because if you don't get the form, you will be able to do the detailed method that will allow you to claim as much as possible.
Sorry, Shaye, did you say all the rent or part of the rent that you can claim for somebody paying rent?
You can claim all in the sense that, at the end. So let's assume I live in a townhouse and I use my basement fully for business. And I can say that 30% of my house space is my basement. So what we're saying is that let's assume in a year I paid rent of 12K, electricity is, let's assume in a year everything is 20K. Do you understand? So what we're saying is that what I can claim as an employment expense will be 30% of that 20K.
Okay.
But someone that owns his own mortgage cannot claim mortgage interest as salary. I don't know why the government feel that people that don't own their property, that law is just, it favors people that are renting than people that own their house. So if you own your property,
I think the reason is that on disposal of your private residence, there's no capital gains tax. So probably that's the reason.
Yeah, and I agree with you. That makes sense. That's one of the reasons. And when the equity of your property goes up, the government does not share part of the equity. The equity belongs to you. They only tax you on. And if it's a principal residence, you won't pay tax on your principal residence. Any other comment, question, so that we can? It's past my idea.
I think, for me, I think the takeaway here is this: just go and look for business and do. Even if you are just,
some people, they buy and sell on Amazon. They register as a retailer on Amazon. They just buy and sell. Some people do deliver. There are so many businesses. Just get something to do. If not, they are just working for the government.
If you do delivery, can you incorporate a business to say that? Because I feel that delivery business is like you already have employers. You're just like the employee, or let's say a contractor to some companies that you do deliveries for. So can someone incorporate a business to say they do delivery?
Yes. You can incorporate the business, or you can just leave it as sole proprietor or incorporate it, depending on the tax situation. But as Ella said, based on my experience, what I recommend to my clients is have a sole proprietor, have an incorporated business. But the sole proprietor business, incorporated business should be used for the business that is profitable. The sole proprietor should be used for business that is not profitable. Not really, you might be making profit, but the profit is not huge, maybe less than 5K, 10K at the end of the year. But so that you can maximize tax deduction as a sole proprietor and also as an incorporated business.
Okay, but for somebody that have like extra one or two properties that is rented, do you advise the person to incorporate or just run it as personal business? Or like a sole stuff.
So there's a law around that. If you have one property or two properties or three properties, it's not necessary. You are not allowed to incorporate it, except for those properties. You are the one doing the cleaning. You are doing a lot of other services for those properties. Like you are the one maintaining that business, those properties yourself. But if you are not, then you can't claim that business is incorporated. You have to treat it as a rental income, and it will be part of your personal income tax.
Okay.
So what the message there is that if that property, you're not doing cleaning, maintaining it, you're not engaging contractor to help you with cleaning and the rest, you understand, it should not be treated as an incorporated business.
Okay, so that means if you're using it for Airbnb, then it can be treated as business because you clean it.
Yeah, but no. Airbnb, there is someone, okay, I think I need to get an information on that. There is one of a member of this group that chatted me on yesterday, and I was able to get some information from CRA tax laws on that. So maybe I will share that information with you. You understand?
Okay,
Or,
that's fine.
or I will post it on the group.
Yeah, so
but
that
I think
because of time.
Yeah.
All right, Shay, please, I have a question.
Okay.
Is Uber regarded as business? Can you register Uber? Maybe if you are doing Uber or something.
Uber automatically, you understand, is a business. You understand? And so the question is, Uber tax filing is treated separately, like different from other individual tax scenario. So Uber business, you understand, you can incorporate it. Yes.
All right,
thank you. Incorporate, yeah. As a sole proprietor, is it necessary to charge GST? It is recommended to charge, because it's when you charge, then you will now be able to claim on your purchases. But if you don't charge and you want to claim, that can trigger audit. But when you charge, you might not be able to charge on everything, but on some, charge, so that you can claim your GST on your purchases back from government. Okay, I think we have covered all the questions. Thank you so much for joining this session. I will share the document and a video with you later in the course of the week. Any other comment or question? Okay, thank you guys for joining.
Can we reach out to you anytime?
Yes, you can reach out to me and just drop a message for me on WhatsApp. I will get back to you.
Oh, great. All right. Thank you.
Yeah. Then we can always agree on, when can we talk? Then we'll surely talk. Thank you guys for joining. Enjoy the rest of your evening.
Thank you so much, Shay.
Thanks for your time, Shay. Have a great weekend.
You're welcome.
Thank you.
Bye.